Bob, I hate to say it, but you're the star of the show here in Bondland. You guys seem to truly be driving everything going on in the markets. What do you think the next move is?
Yeah, today's a bad day to be a bond. Prices are going down and investors are running for the hills. We don't think, pardon me, we don't think what we're seeing is anything unusual. In fact, if yields weren't backing up, we'd be a little bit surprised. We've seen this before. It's interesting you mentioned 2007. Let's go back to 2007. The Fed finished hiking rates in June 2006. Yields rallied a lot. Then in June 2007, yields went up well over 100 basis points, retested the old highs, and kept going. And at that time, the Fed was declaring soft landing. We're seeing the same things now. So
are you worried? Well, it sort of sounds like what you're saying is yields can keep moving higher, but also we can see a much weaker economy. So as that tug of war shakes out, do we hit 5% next? Do we go above that level? Do we pull back? What does that mean? Well, we are seeing a much weaker economy right now. If we look at core personal consumption expenditures, the Fed's key measure of inflation, and look at the last print, take the last 3 months and annualize it, you're at 2.16%. So you're pretty much bang on the Fed's target. If we look at housing, which is one of those things that is most interest rate sensitive, housing affordability is the lowest on record since the data's been accumulated in 1986. We're in the sort of Warren Buffett camp that you want to buy when things are on sale. Things are on sale now. We have clients coming in to buy. We think it's a good strategy right now. Well, the things you're buying are kind of muni bonds, some agency mortgages, like you said, some of the local emerging markets. Dan, let me turn to you for some context on what this all means for equities. How much of a headwind is it? We're seeing, obviously, for certain sectors like utilities, a pretty substantial one.
Yeah, Kelly, I think it's always a tug of war when it comes to the equities between the positive impact of, better growth and commensurately higher interest rates, with the higher sort of impact on liquidity, valuations and interest costs. I think for most companies, they actually take the higher growth with the higher interest rates, which I think is a big component of what's happening in markets this year. But as there's an increasingly big component of the market that's, that's more sensitive to higher rates, which is the higher valuation components as well as the bond proxies, as you mentioned, Kelly. So yeah. I think it's not a uniform winners and losers story. So you really got to be a pick where you play your battles. Have you guys, am I correct in thinking you've been somewhat cautious on the Magnificent Seven? And does the trading complex today, even though the NASDAQ is outperforming, lead you to stick with that view? Yeah, I think that's right, Kelly. I mean, I think that, returns are greatest where capital is scarce. Risks are greatest where capital is expensive and concentrated. That's, where the risk is expensive and concentrated. So we think it's better. You're better off avoiding those areas. And keep in mind that these are cyclical companies. And so, we think that profits at bottom. We think that they will benefit from a higher profit growth outlook. But there's, tons of other companies that trade at a fraction of the multiple that are going to accelerate faster and benefit more. And that's where I think that investors are best served, putting their dollars. You're looking energy, industrials, materials, in particular, value kinds of areas of the market. Bob, it's really kind of gaining traction, this idea that central banks globally are going to keep hiking or talking about higher for longer or whatever until they, quote unquote, break something. Do you share that view? And what does that mean? What does that look like in practice? Well, I think you're right. I think they're intending to talk tough until they see inflation really down at around their targets and a wider range of things. But they also talked kind of tough that inflation was transitory at the end of 2021 and walked into 2022 and started hiking rates. So I think you have to put what they're saying aside, and you've got to look at what's going on. The consumer, which drives the economy, has depleted their excess savings. It's below where it was pre-COVID. They're trying to maintain their level of spending. They're putting more on revolving credit. You're seeing credit card usage go up. They're paying in the mid-20s% annualized rate for that. That's unsustainable. We think this is where you go in and buy bonds. If you're a municipal bond investor, a general muni bond fund at a minimum yields 4.5%. A year and a half ago, it used to yield 2%. If you're a taxable investor, go in and buy an aggregate bond index. You're up over 5.5%. A couple years ago, that was about 1%. Bonds are cheap now
real yields are very high.
They are. And if I could paraphrase, you're saying basically the downturn will trump deficits, will trump the government deficits when driving yields higher.